Welcome to the Capital News. I am your host, Alex Karitis. Today is February 26, 2019. Thanks so much for joining me. It's a pleasure having you. Getting into the economic news of the day, let's hit the U.S. stocks. The S&P was down 2 points. The Dow was down 34. NASDAQ was down 5. Russell 2000, the small cap index, was down 11 points. Not much movement in the oil, gold, and silver markets. I don't know if this was because people were still afraid that President Trump, even though he is in Hanoi, Vietnam, meeting with the leader of North Korea, Kim Jong-un, they were afraid that President Trump might tweet out again, "Woohoo, cool your heels, OPEC. I don't like these production cuts. I want oil prices down, down, down." I have an issue with this, ladies and gentlemen. I know I've stated several times before in regards to the president's tweet following the major sell-off last quarter in the stock market saying buy the dip, and then the market rallied 1,000 points, and then subsequently we have all the breadcrumbs littered all over the place over these past few months in regards to the U.S.-China trade talks, and then the market rallies because it's like catnip. It's a little bit of news. We really don't know what it is, but it's news, and it seems to be good. It's in the right direction, so the markets rally. I understand the president has sort of hung his hat on the economy and the stock market. Again, I think that is a huge mistake. He never should have done that. I think he sort of boxed himself in. However, I do think the president has the skill set in the bully pulpit to do the Potomac two-step and sort of dance his way around what may be coming as far as an economic downturn of some sort or a stock market sell-off again of some sort. I just have an issue with this type of stuff. And the reason is because when you have a president, or any world leader for that matter, that comes out and makes a statement, in this case, these are tweets, and says, buy the dip, and then the market actually rallies 1,000 points and has continued to go up in this V-shaped recovery for 9 straight weeks, especially in regards to the Dow and the NASDAQ, but pretty much equally true for the Russell 2000 and for the S&P 500. And then the president comes out just the other day and tells OPEC to pretty much cool their heels, and then you have a sell-off in oil. You get where I'm going with this? That is too much power. These are supposed to be markets. These are supposed to be free markets. Now, of course, they're not entirely free, and when you have one person with the power to move these markets seemingly off of a comment, off of a tweet, that's not a market. That's a dictatorship. That is not what the presidency of the United States is supposed to be about. As a matter of fact, not supposed to be. It isn't. That's not what it's about. In fact, we fought a revolution because we were fighting that type of system. The king comes out, makes a decree, blah, blah, blah. It's so. That's pretty much it. That's what we were against. The presidency is supposed to be, and this might come as a shock to most people, but it's rather supposed to be ineffective. He's just supposed to be sort of there. He's not supposed to be involved in everything. How this has come to be, I don't know if this is just human nature, but it is not good. I mean, we were warned about this from our founding fathers, to not allow government to get to the size that it is. I mean, we blew past that long time ago, but now we just continue to put more and more power in the hands of a single individual, the President of the United States. You have Congress that is just relinquishing its power, then gets upset when presidents, Democrats and Republicans, start to use that power, and they say, "Oh, we don't like this. We have to take some of this back." But of course, they've already relinquished their power, so the president's going to use it. Now you have this slippery slope. What president is going to start what precedent about this policy? I mean, it just becomes a slippery slope. Where does it end? So I have a problem with this. Now, you've been following this podcast. You know that there are a lot of things that I like about this president. I think he's going to win 2020 probably rather easily. I know a lot of people don't think that's the case because he is tying himself to the stock market and to the economy, and that there's just a lot of people out there who don't like him, and then you have a whole bunch of progressive liberals out there who are really striking a nerve, and a lot of people that obviously don't like the president, and then they're offering a whole bunch of free stuff with a whole bunch of people who are struggling, even though this is supposedly the best economy ever, and you've got 78% of Americans living paycheck to paycheck, and then you have these lunatic fringe liberals, socialists, Democrats, socialists, whatever the hell they want to call themselves, out there promising free stuff to everybody, it becomes an attractive campaign slogan. So, despite the fact that all of this free stuff is being offered, of course it's not free, I still think that the president is going to win, and I think he's going to win pretty handily. So I'm not afraid to say that. I put that down here. You can sign, seal, deliver it. We'll see what happens. But I am going to stick by my guns, even though I have some issues with him tweeting these things and getting involved in these markets. And then the bigger problem is it's one thing to say them. It's another thing for the markets to actually sort of follow suit. Because here's another issue that I have with it. It's one thing to say it. It's another thing for the markets to react to it. But it's another thing because the president didn't come out in October and tell everybody to sell the market short, or to at least, in the very least, get your money out of the market because there's going to be a sell-off and you can save yourself 20%. I mean, that would have been a pretty good tweet. You could have saved a lot of people a lot of money if you're so concerned with everybody's 401ks. So just putting it out there. If you're going to do it one way, do it both ways, or don't do it at all. I say don't do it at all because you shouldn't. So that's my little soapbox spiel for the day in regards to President Trump and his tweets regarding the stock market, the commodity market, and any other market for that matter. Now, moving on to some other news. We had some information come out today, some economic information, and it was in regards to the housing market. Home price growth drops for ninth straight month. The housing market is showing signs of slowing as the S&P CoreLogic Case-Shiller National Home Price Index posted a 4.7% annual gain in December, down from 5.1% in the previous month. This as Home Depot misses earning estimates and house starts are down. So that is true. This is further information that there seems to be a slowing down in the housing market. Is this a harbinger of things to come? Is this a slowing consumer? We know about the rising delinquencies in the auto market. I've had that conversation with you guys several times now, and we'll probably continue to, because we're going to track that very closely, because you have a record number, 7 million Americans who are 90 days plus past due on their auto loans, which is that's a record high. That is a record high. That is higher than they were shortly after the Great Financial Crisis, the Great Recession, whatever you want to call it. So things are not going in the right direction, especially when we're told that unemployment is as low as it's ever been, or I shouldn't say as it's ever been, but in decades, which is true, which has been the case. I'm starting to sound like Donald Trump. I'm just starting to exaggerate. Don't let me do that. But there is some mixed news. So on the one hand, you have unemployment down to decade-level lows, but on the other, you have a consumer, despite supposedly being employed, having trouble making their auto loans, which one would think if you have a car, you need it to get to and from work, you need to get some groceries, you need to get the kids back and forth to wherever they got to go. I mean, it's not typically something that you stop paying. So that's typically a bad sign. That's a harbinger of bad things to come, but we're going to monitor that closely. We also know that there are rising delinquencies in the student loan space, which again should come as no surprise. That's hitting records as well. We're near $1.5 trillion in the student loan debt market. I mean, that's just astronomical. It's astronomical. It's just a straight line. I mean, if you look at this graph, it would just sicken you. It's like, are you serious? It's highly predictable in its trend. And if this trend continues, I mean, I don't know how anybody is going to be able to afford to ever buy a house, regardless if there is a massive sell-off in the housing market or not. If you're riddled with that much debt, student debt, and then if you don't have a job or not a good enough job to pay off the student loans, an auto loan to get to and from work, I don't know how the hell you're going to be able to afford a house. I just don't know how you're going to do it. And then everything else that goes along with it. So you might be, as they say, house rich, but cash poor. So you're going to have a house, but then when people come knock on the door, there's no furniture on the inside because you don't have the money to do it. So there is just one thing after the other that is not painting a very strong picture for the U.S. consumer. And of course, it isn't just the U.S. consumer, it's the consumer all around the world. This is what happens, ladies and gentlemen, when you buy so many things on debt. Plain and simple. It's highly predictable. Debt is purchasing and bringing forward future demand today. You don't have the money. That's why you went into debt. That's why you got the loan. You couldn't afford the house or the car or the education, so you needed a loan. So you brought all of that forward. Now you got to pay for it. With what? What kind of job do you have? Do you have a job? How many jobs are you working? I mean, what's the case? When you have 78% of Americans living paycheck to paycheck, that's not a good sign. When you have savings that are almost non-existent, that's not a good sign for the economy. And an economy is supposed to grow off of savings and investment. When you have no savings, it's very difficult to grow an economy. And when you have people in the Federal Reserve and central banks around the world embarking on quantitative easing, negative interest rates, and just printing money, it doesn't work. It just doesn't work. It's a temporary hit. It's a temporary hit of cocaine. It's a temporary hit of heroin. You feel good for a little bit, but you are going to come down from that high. And believe you me, it ain't going to be pretty. And the further we kick this can down the road, the worse it is going to be. Now, here's another article, this one out of Fox News, in regards to the housing, titled U.S. Housing Starts Plummeted 11.2% in December. The number of homes being built in December plunged to the lowest level in more than 2 years, a possible sign that developers are anticipating fewer new houses to be sold this year. The Commerce Department said Tuesday that housing starts fell 11.2% in December from the previous month to a seasonally adjusted annual rate of 1.08 million. This is the slowest pace of construction since September 2016. Over the past 12 months, housing starts have tumbled 10.2%. December's decline occurred for single-family houses and apartment buildings. Builders have pulled back as higher prices have caused home sales to slump, suggesting that affordability challenges have caused the pool of would-be buyers and renters to dwindle. Artificially high prices have created affordability constraints, resulting in a situation where builders cannot deliver supply in scale, said Brad Dillman, chief economist for the multifamily developer Cortland. The result is that today's housing market is undersupplied. It's undersupplied. The Commerce Department reported last month that new home sales in November were 7.7% lower than a year ago. The housing market initially cooled last year as average 30-year mortgage rates climbed to nearly 5%. Home prices have consistently risen faster than wages, and the inventory of homes listed for $250,000 or less is tight, suggesting a sluggish market ahead. But the average mortgage has fallen since November, and that may help some Americans to become owners in 2019. Also, the pace of rising prices has slowed while wage growth has accelerated in recent months, which could also boost sales. Looking forward, we may see a few more months of weak single-family starts before increasing confidence leads to increased production, said Danielle Hale, chief economist for Realtor.com. Permits to build housing, an indicator of future activity, increased just 0.3% in December. Among single-family houses, permits fell 2.2% in December and 5.5% from a year ago. Housing starts were flat in the Northeast in December, but fell in the Midwest, South, and West. So this is nationwide. This isn't location, one area. This is across the board. So we have a general trend here that has a negative bias. This is not good. Now, you have some people here who are saying that wage growth might be able to boost sales coming on. Well, we just had this discussion 2 seconds ago in regards to 7 million Americans basically defaulting, or at least 90-plus days past due on their auto loans. We have record-coming delinquencies on the student loans. I mean, I don't know what a few percentage points in your wage increase is going to do to solve this problem. It's not enough. And just for the record, I don't trust these government numbers when it comes to these types of increases because I don't trust the inflation figures. I just don't. If you think your cost of living has only gone up 1.8, 1.9, even 2%, stick around. I got a bridge to sell you. You know better than this. You know better than this. You know housing prices have gone up more. I just read you the data. They have. Even when they're falling, they're still higher than your wage increases. They're still higher than the stated inflation rate. What about your healthcare costs? What about your food costs? What about your education costs? These things only go up 2%? You wish they only went up 2%. So don't be blinded and fooled when these people come out and say, well, everything's fine and inflation is it's under control. No, it isn't. No, it isn't. But, I guess if they can continue to say this enough times across enough media platforms, you just start to live with it and you just start to deal with it and you continue about your business. I don't think that's the right way to handle it, obviously, but that's the way these people want to continue doing business. I say wake up and do something about it. Now, moving on. Now, the market's obviously closed down today, but there was some whipsaw action. There was some whipsaw action in part because of the housing numbers that came out, in part because of the Home Depot earnings that came out where forward guidance was not as great as the market was looking, which really reflected these housing numbers, which is no surprise. It's the Home Depot. That's where they make their business, contractors and do-it-yourself homeowners who want to fix up their house and their property and whatnot. So everything is going in the same direction. Yet the S&P was only down 2 points. The Dow was only down 34. NASDAQ was down 5. So, what's going on here? Is this the backstop? Is this the major banks coming in at the last hour to prop this thing up, the plunge protection team? Is this the share buybacks that are still propping this up? What is going on here? You have news after news after news that confirms why the market sold off 20% last quarter, and the market's barely moved to the downside. This is Oz. This is Fantasyland. I don't know how else to explain it to you. We are just completely detached from reality. I don't think that sets up for a good outcome once the piper does actually get paid and we do hit reality, or reality hits us straight in the face. So again, prepare yourselves. I'm not saying run for the hills, not by any stretch of the imagination, but if you're closer to retirement, I do suggest that you get defensive, get more into bonds, some short-term government bonds, some very strong corporate bonds, and defensive stocks. That's really the best thing I can tell you. If you like gold and silver, get gold and silver. But start to trim some of your positions, especially if you've made some money on this crazy V-shaped recovery. Be smart, don't get greedy, and just, if you got to sit on the sidelines, you got to sit on the sidelines. But that's for somebody who's a lot closer to retirement. If you got 30, 40 years to go, that's up to you. If you want to put your money on the sidelines, you can. If you want to stay in, these bumps and bruises come, you do what you got to do. Now, the other piece of news that was today was Chairman of the Federal Reserve, Jay Powell, went to Congress for his semi-annual meeting where he testifies and gives information to Congress. He met with the Senate Banking Committee today. I believe he meets with the same committee in the House tomorrow, and basically not much happened. It was a 3-hour hearing. There really wasn't anything that was a bombshell. The markets didn't rally or sell off majorly in any direction here in regards to the chairman's comments. He towed the line. Like I said, he learned his lesson. He learned his lesson in November and December of last year when he started to say, well, yeah, everything's on autopilot. We're just going to continue to sell off the Fed's balance sheet. We might be a little bit more patient or flexible with the interest rate hikes, but as far as the balance sheet is concerned, that's on autopilot. He learned his lesson. He was called out. You had Uncle Ben Bernanke come out. You had Aunt Janet Yellen come out. No. You know the story. Let's do the 180. Let's do a wait and see. Let's be data dependent. And then, the drug addicts loved it in the stock market, and the thing just rallied. And, just took off like a bat out of hell. And that's what we've been living with here for the past 9 weeks. So is this thing going to come to an end? I don't know. We're going to find out because we're at those technical levels that we keep bouncing around. Is this going to be, where's the next catalyst? I don't know. That's sort of why I throw my hands up in the air. I can't really give you an answer as to what the next catalyst is going to be to the upside because technically a lot of this stuff should already be priced in. So we know the Fed is going to be patient, a wait-and-see policy, data-dependent, with I don't want to say more biased towards the downside, but definitely not hawkish, definitely not as hawkish as they were in the fourth quarter. And then you have President Trump with all of the breadcrumbs in regards to the U.S.-China trade talks. Well, President Trump and President Xi of China are supposed to meet here shortly. So how much longer can that be strung along? So, and that could be very much the case of buy the rumor, sell the news, sell the fact. So where's this upward swing going to come from to really move these markets to new highs? Could it happen? It sure could. Again, we're in the land of Oz. We're in fantasy land, so anything could happen. Now, in regards to this testimony, I think a couple of the most interesting points, at least from my opinion, we had the second in command, the ranking member, Democrat Senator Sherrod Brown of Ohio, who I believe may throw his hat into the 2020 campaign election as well. He may be a contender. We'll see what happens with him. But he gave an opening statement in opening questions that was really reminiscent of this podcast. I couldn't believe it. Again, sometimes I'm a libertarian, so there are instances where there's going to be a lot of overlap in some cases with my views and some members of the Democratic Party. It shocks me all the time, but it does happen occasionally. It does happen occasionally. Again, they might be able to identify a problem, but their solution is usually radical and just flat out wrong. But nevertheless, to solve a problem or to identify a problem is a step in the right direction and is very much needed in order to solve a problem. So what did Senator Brown mention during some of his opening remarks and questioning? Well, he basically brought up everything that I just discussed here earlier. He brought up the student loans. He brought up the auto loans. He brought up the income inequality that exists. And what is the Fed's role in this? How can the Fed tackle this problem? Is it the Fed's doing? I mean, go to thecapitalnews.com and read my article on this when I questioned Chairman Powell. What Americans are you working for? What Americans are you talking about? Who are you benefiting here? Because your policies do have an effect on people. And a lot of the senators were asking, what's going on with wage increases and wage growth? Why is inequality growing? Why is all of this money staying at the top? Well, I'll tell you why. And you don't need an economics degree to understand this. You have the Federal Reserve that prints money. It expands it. Who does it give it to first? It gives it to the banks first, the wealthy individuals, major corporations and the like, and they have all of this play funny money. And there's no inflation at this point, meaning there's no increase in prices. There's inflation from an increase in the money supply, but the effects of inflation have not yet taken hold. It's too early yet for it to happen. So all of these people have a question. They have all of this money in front of them. The question is this: do I take this money? Do I keep it? Do I put it in my pocket? Do I take it and buy financial assets, plants and equipment? Or do I just throw it out the window and give it to everybody else? What do you think these people do? They put it in their pocket, they buy financial assets, and then some scraps will eventually make it down, and then the inflation will take hold, those financial assets will go up, their incomes rise, they're wealthier than they were before, and now everybody else has to feel the effects of inflation adversely, and the rich get richer and the poor get poorer. I don't like to have these class debates and put people in these classes, but let me just tell you something. This isn't a free market economy, ladies and gentlemen. I just talked about President Trump having the power of the tweet to move markets, and you have the power of the Federal Reserve chairman and the members of the Federal Open Market Committee that can move markets, that determine the price of money, the price of capital. That is not a free market. You have companies that are joined at the hip with our representatives, with our senators. This is not a free market. This is such a perverse, sick, twisted combination of cronyism, of fascism/corporatism with a huge and bigger side of socialism coming. So this is just a perverse economic experiment that we are running in the United States of America. But don't worry, everything's great. Okay. Another senator who made a good point, and brace yourself, it's Senator Elizabeth Warren. She loves to sit on the banking committee because she loves to rail against the banks. Now, what was her point that she made? She said, well, Chairman Powell the Federal Reserve is a major banking regulator, which is true. She then went on to ask the chairman how many mergers and acquisitions have been denied by the Federal Reserve over, I believe, a period from 2006 to 2018 or 2006 to 2019. And she came prepared because she had already asked the chairman this question in writing, and he had already submitted an answer to her. So she was prepared, just like a lawyer is supposed to be, just like anybody who's questioning should be. And he basically said, well, I don't know the number. She said, well, would you be surprised if it's 3,000 and some odd number? And he said, no, I wouldn't be surprised. And she's like, good, because that's the answer you gave me before. And he agreed with it. So her point was the Federal Reserve has the ability to stop mergers and acquisitions. She has a problem with too big to fail. I have an issue with too big to fail. I mean, that's what our book is about. The Cynic's Guide to Investing is about too big to fail. I mean, that's just what it is. So she's sort of going after Chairman Powell on this issue, that none of these were turned down. But there were some banking mergers that were withdrawn. So if one company you said, well, we don't want to do this anymore, they would withdraw, and then obviously it was no longer approved finally because they withdrew. The point that Senator Elizabeth Warren was making was the fact that these are not public hearings. The public doesn't have a say as to whether or not these banks are allowed to merge or know any of the details. The Federal Reserve can make the decision or give the guidance to some of these banks to say, hey, you know what? I don't think you're going to go through the next step. You're not going to get approval, so just withdraw right now. Just withdraw right now. You get what I'm saying? So they refuse no mergers and acquisitions, and if a merger and acquisition doesn't go through, it's because the Federal Reserve gave the banks the advice, it's not going to go through to the next step, so just withdraw your bid, and that's what happens. So Elizabeth Warren's point is we are looking for transparency, which is a point that I don't even think she fully realized that she made now that I sit here and think about it, because the Federal Reserve, especially Jay Powell, just wants to be this most transparent Federal Reserve chairman ever. So she's basically calling him out and saying, well, here you go. You want to be transparent with this? Why don't you let the American people know that you're going to make a bank that is too big to fail? Because being too big to fail means if something goes wrong, not if, but when, the American taxpayer is going to be on the hook just like they were last time. And that's not right. And I agree with her 100%. It's not right. Those banks should have been able to fail. That's the free market system. If there was value, there was a lot of money in the economy. It was sitting on the sidelines. If people saw value in those banks, they shouldn't have had any problem going in and saying, I want this unit of this bank. I want this unit at this price, yada, 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 down the line. That's how it works. So I know you may have bit your tongue, stubbed your toe, passed out. I actually agreed with a couple Democrats here. But this goes to my point. Now, they don't have the solutions. Believe you me, they don't have the solutions. But they have identified problems, and they're not afraid to call out these people, whether it's for political purposes or not. They're doing it. And I have to applaud them for it, because people have to wake up. This is not a free market system, yet it's free market capitalism that gets blamed. This is a nasty hybrid of fascism and corporatism with a huge side of socialism, and that huge side of socialism is getting bigger. So you got to wake up. You have to wake up. You have to educate yourself. I try to do my best on this program every day through my website, through some other YouTube videos, through writings, every way I can do it. But I'm a one-man band. I can't do it all. You have to go out there and educate yourself. You have to share, like, and subscribe. You have to get the word out. Leave your comments. I would love to hear from you guys. Thank you so much for joining me. It's been a pleasure. This is the Capital News. I am Alex Coraitis. Godspeed.